Roy Smith is our market analyst this week. The U.S. Department of Agriculture believes U.S. farmers are wrapping up the second largest corn harvest in the country's history. The agency's projection, released in its November crop report last week, has been another negative factor for market prices. The December 2017 corn futures contract set a lifetime low with Tuesday's close at $3.38 per bushel. When we last talked with Roy, he was tracking the dead cat bounce in soybeans. His strategy is to find the low cash price during the harvest season, then measure the rebound in prices for potential selling opportunities. We talked with Roy again Tuesday afternoon and began by asking for an update on that movement.
Everybody's looking for the dead cat bounce, and we're used to seeing 25 to 50 cents a bushel rally off the dead cat bounce. Here we had one day where we got 50 cents. We got 50 cents one day, and then the market fell back. And it seems like this year, well, I shouldn't say seems like it, I've never seen a market like this, because we got that rally on that dead cat bounce, and we got just to where it's almost ready to trigger a sale, and then the bottom fell out. We went through that, according to my notes, we went through that process 4 times. And as we speak today, the market's down again, and all I can say is this was a case of really watching the markets close and pulling the trigger when you had the opportunity to maybe avoid some storage costs as opposed to make $1 a bushel. I don't think that's going to happen this year, but you can use your cash flow for this year's crop and get it moved, get it gone, so that you don't end up trapped in excess corn and soybeans like maybe we have.
Are you surprised at how stagnant this corn market has become?
If you look back at the early part of the year, we had a really good harvest a year ago in 2016, and then gradually that market has just eroded away, and every time we think there's an opportunity to make a sale, it didn't happen. I've watched the market go up and down 4 times in the last year, and none of them very good. And so the question is, am I surprised? Well, no, not exactly surprised, but I'm sure disappointed.
Can you use those deferred contracts for the large carry that we're seeing in corn? If you look out to December 18, for example, you're getting almost 50 cents over December 17. Is there a way to implement that into your marketing strategy?
Well, I'll just throw this out for something to think about. Yes, you can forward price for delivery next year and 38 to 50 cents a bushel over where it is today. But if you do that, what do you do with the corn next year when the bins are already full of this year's corn? And that's the thing that I'm most afraid of, is that the farmers don't sell when they could have, and the market goes down like it did today, and they still have the corn, and sooner or later, somewhere, sometime, that corn has got to find a home. And we certainly hope it's a little better this year than last, but no guarantees.
Whether or not this year will be the same, what usually happens with basis as we close out harvest?
Usually you get a basis improvement once the harvest is going to town, and maybe get just a little bit of a bump in the cash price, which this year it doesn't look very likely. But considering that and what I said about the cash flow, you need to be ready to pull the trigger. Now, I watched some market analysts on some of the other media, and it seems like most of them are pretty optimistic about getting enough demand to get the crop moved. But there's a lot of corn out there, and getting enough demand to move that mass of corn is going to be real touch and go.